For 2 decades, India's IT story had no parallels. The blue-chip IT stocks were the bellwether for the Indian stock market. India's IT services exports were booming and there was no looking back until artificial intelligence came about. Now, in the latest AI-led disruption, Wipro will be dropped from Nifty50. Now, this means Wipro will no longer be among India's 50 most valuable companies. Now, this is a fall from grace for a company that defined India's own IT Big Five. Now, to understand why this matters, you need to know what the Nifty50 actually is. Well, it's a list of India's 50 biggest, most liquid, most influential publicly listed companies. Now, being in the index is enormously valuable. Billions of rupees from passive index funds automatically flow into every stock on that list. Now, being dropped means those funds automatically sell the stock. So, how does a company get dropped? Well, the metric is called average float market capitalization, or AFMC, essentially the market value of shares available for public trading averaged over time. Now, the National Stock Exchange's rules say that if a replacement candidate has an AFMC more than 1.5 times that of the smallest current index member, it becomes eligible to swap it. Now, Wipro's AFMC has fallen sharply because the company's stock declined significantly over the past year, weighed down by a broader IT sector slowdown, soft technology spending by global clients, cautious management guidance, and shrinking order volumes, particularly from the banking and financial services segment. Now, its fourth quarter FY26 results reflected the strain. Net profit fell 1.9% year-on-year, even as the company approved a 15,000 crore rupee share buyback. Now, the Wipro story is one data point in a much larger, more uncomfortable picture. India has just crossed an unwelcome milestone. For the first time in years, not a single Indian company ranks among the world's top 100 listed firms by market capitalization. As recently as early 2025, 3 Indian companies held a place on that global list: Reliance Industries, HDFC Bank, and TCS. Today, none. The broader sell-off has been brutal. India's market value peaked at $5.73 trillion in September of 2024. Since then, $924 billion has been wiped out. Foreign investors have withdrawn a net $42 billion since the end of 2024, pushing their ownership of Indian equities to a 14-year low and below domestic institutional holdings for the first time in over decades, according to Goldman Sachs. Now, India's weight in the MSCI Emerging Market Index has collapsed from around 19% to roughly 12% in just over a year. Now, the country that was once closing in on China in emerging market portfolios is now being actively exited. So, where is the money going and why? Well, the answer is artificial intelligence and India's complicated relationship with it. The global AI race is being led by companies building the models, the chips, the platforms, and the infrastructure. The US has OpenAI, Nvidia, Microsoft, Meta, and Google. China has got DeepSeek, Alibaba, and Baidu. Taiwan and South Korea are powering the semiconductor supply chain that makes AI possible. Their equity markets reflect it, up 42% and 78% this year respectively. India's benchmark index is down more than 9%. Now, India's stock market is heavily weighed toward IT services. That's a $315 billion industry led by Infosys and TCS. Now, for decades, this model worked. Take global corporate work, offer skilled talent at competitive cost, deliver software at scale, but generative AI is now automating parts of that very work: coding, testing, back office functions at a fraction of the cost. Investors are asking a hard question. If AI writes the code, what happens to the outsourcing model? Well, India optimized brilliantly for services exports, but building foundational AI is a different game entirely. Training advanced models requires massive data sets, specialized chips, enormous compute, and billions of dollars in capital. And that's why this race has concentrated among a handful of global giants. Now, India has the talent, the users, but not the infrastructure or the models. But here's the nuance. Missing the first wave of AI does not mean missing the entire opportunity. Now, AI is entering a second phase of not just building models, but deploying them across industries at scale. And this is where India could still carve a meaningful role. AI in banking, healthcare, education, governance, even manufacturing and small businesses delivered to one of the world's largest digital populations. Now, Indian IT companies are already repositioning, talking less about traditional outsourcing and more about AI integration, consulting, and enterprise transformation. But investors are demanding proof, not promises. Which brings us back to Wipro and Nifty50. Now, this isn't just a routine index reshuffle. It's a market sending a signal that India's old growth engine is slowing and a new digital economy is being demanded as a replacement. Now, only time will tell whether India can build its own version of the AI economy before this gap becomes structural.